Loan to value isn't just some meaningless number that mortgage lenders like to throw around. It can literally determine the interest rate you get, the loans you qualify for, and how much more equity in your home that you can even leverage. So it's really critical to understand what this number is and how it applies to you if you plan on buying a house. Today, we're going to do exactly that. We're going to learn what LTV is. We're going to go through some examples and look at how this number affects your options as a borrower. Now, quick warning, we're going to do a little math today, but I promise it will be painless. So what exactly is loan to value, or LTV in the lender lingo world? Loan to value is the amount you owe on your home, your loan amount, in relation to the home's value expressed as a percentage. Basically, the LTV is the percentage of the home's value that's financed. If it's helpful, you can think of your LTV as the opposite of your equity. So if you've got 20% equity, you've got an 80% LTV, just as one example. So how is this calculated? How is LTV calculated? It's very simple. You just take the loan amount and divide it by the value of the home, then multiply that by 100 to get a percentage. The more equity you have, the lower this percentage will be, the better your options will be when it comes to borrowing money. Once you get below 80% LTV, your options really open up. So stick around because we're going to get to that shortly. When you're purchasing a home, how do you calculate it and how does it affect your mortgage? Well, if the LTV is the loan amount in relation to the value of the home, then let's start by looking at how value is calculated. Most of the time, it's going to be determined by your sales price. So you will take the sales price, subtract your down payment to get your loan amount, then just divide that number by your sales price to get the LTV. So let's look at an example together. Let's say you're buying a home for $200,000. You're going to put $25,000 down. You would subtract the $25,000 from the $200,000, giving you a loan amount of, you guessed it, $175,000. Then you're going to divide that $175,000 by the $200,000 sales price, which gives you 0.875 or 87.5% LTV. Lately, we've been hearing crazy stories about people getting into bidding wars and paying way over asking price. In these situations, what happens when the appraisal comes back and the home is valued less than the sales price? It's a big question I'm getting a lot right now. When this happens and the appraised value is less than the sales price, then the appraised value is used to calculate the LTV instead of the sales price. So if we go back to our example where we're buying a home for $200,000, $25,000 down, let's say the appraisal came back and the home was appraised at a value of $190,000. You're still going to subtract your down payment amount from the purchase price because unless you've negotiated a new price on this low appraisal, that's how much you still have to come up with to buy the home. So we subtract the $25,000 down payment from the $200,000 price, giving you $175,000 that you need to borrow. That's your loan amount. Then you divide that $175,000 loan amount by the $190,000 appraised value, and now you're getting an LTV of 0.921 or 92.1% instead of the 87.5%. Why does this matter? Well, it matters for three main reasons when you're purchasing a home. The first is that the lower the LTV, the better the interest rate you qualify for. Lenders are always looking at loan applications and evaluating the risk involved in lending a person money to buy their home. And lenders view loans with higher LTVs as having a higher risk. It's like you have less skin in the game, you know? They view loans with lower LTVs as a lower risk because the owner has more skin in the game. Second, your LTV matters because it affects the type of loan you're able to qualify for. USDA, RD, and also VA loans will allow up to 100% financing or an LTV of 100%. So if you're able to qualify for either of these loans, you potentially can buy a home with no down payment. But remember, you'll still have some closing costs. So I'm not saying $0 out of pocket. While with an FHA loan, generally, you're required to put at least 3.5% down. So they'll only allow an LTV of up to 96.5%. If you qualify for a conventional loan, especially if you're a first-time home buyer, it's actually possible to approve for financing up to 97%, requiring only a 3% down payment. This leads me to the third reason why your LTV matters when purchasing a home. But hey, real quick, if you enjoyed the first two reasons, go ahead and smash that like button. It really helps to support the growth of my channel and tells YouTube to recommend this to others. Now, the third reason why your LTV matters when purchasing a home is mortgage insurance. When we're looking at conventional loans, if you finance more than 80% LTV, you will generally be required to pay for PMI, which stands for Private Mortgage Insurance. Sometimes you're able to negotiate a higher interest rate for the lender to pay for this, or work out a deal where it's a one-time payment for PMI versus the standard monthly. But in general, one way or another, going conventional, you will pay PMI if you're putting down less than 20%. But you know what? If you don't have 20% down, that's okay. And if you're paying PMI, that's okay too. A lot of buyers, especially first-time home buyers, don't have 20%. So this mortgage insurance allows you to buy a home when you otherwise couldn't. I don't know about you, but that makes me happy. Then from there, you can always work towards that goal of 20% equity. If that's the case for you, watch your mortgage insurance each month and pay attention to that loan amount. Once you've reached that 20%, you can contact the lender and ask that PMI to be removed. In my last video, I talked about paying off your mortgage early, and in it, we discussed making extra principal payments towards your mortgage to pay it down faster and save you money on interest. Guess what? If you're paying monthly mortgage insurance, making extra principal payments on your mortgage can also help you to drop that PMI even faster. I'm going to include a link to that video in the description below because I'm hoping that you'll love to check it out. Real quick, if you want to buy a home but you're not sure where to begin and you feel anxious just thinking about the mortgage process, I've created a quick and easy course to walk you through it step by step. It's called Homebuyer 101 and it covers everything you need to know, from finding the right lender to preparing for your loan package to closing on that new home. Don't leave the biggest purchase of your life to chance. Get educated so you can confidently buy the house you love and get a mortgage you love just as much. If you want to learn more, I'll include the link in the description below. So, now that you're an expert on how to calculate PMI and what it means for the type of mortgage you qualify for, but what if you're purchasing a second home or investment property? Everything up to now, we've been talking about a primary residence. Does that change anything? Oh my gosh, a big fat absolutely, you bet. To put it simply, the LTV limits are going to be lower. You're going to have more skin in the game. Given the same loan amount with the same credit score, the loan to value allowed for a second home or investment property will always be lower than the LTV for an equivalent owner-occupied property. That means you're going to put more money down in order to purchase that home. Why? Because it's risky. Remember we talked about lenders viewing lower LTVs as a lower risk, so they reward it with a lower interest rate. Well, when a lender is considering approving your loan, they evaluate your application based on several risk factors. Whether the loan is for a second home or a primary residence or an investment property, that's going to be one of those factors. Think about it like this. Let's say you have your home, your primary residence, and you still owe some money on that. And you have a second home where you spend your summers near your extended family. Let's say something unforeseen happens and you're no longer able to make both mortgage payments. Which one are you likely to make the payment on? It's much more likely that you're going to default on a vacation home, rental property, investment property than your primary home that your family lives in that puts a roof over your head. So these loans come with more risk, meaning lenders will require more money down. They want you to have more skin in the game, and you're also going to pay higher interest rates. So what if you were financing your mortgage or trying to cash out some of the equity that you've built into the home? If you're looking to just do a standard rate and term refinance, then most of what we talked about for LTV is pretty much still going to apply and it's still going to work for you. When the lender calculates the LTV on your refinance, it will always be based on the appraised value of the property, which is why an appraisal is needed when refinancing your home. But if you're looking to cash out some of the equity that you have in your home, what then? This is where your LTV can help you to understand your options. The general rule of thumb is that you can refinance and cash out up to 80% of your home's equity, meaning you can refinance a new loan with an LTV up to 80%. When going through this process, everything we talked about when purchasing a home would apply to your new loan. So the lower LTV you refinance, the better interest rate and better loan you're going to qualify for. There are other options for accessing equity in your home without doing a full refinance, such as a home equity loan or a home equity line of credit. A home equity loan, it's often referred to as a second mortgage. This is where your current mortgage stays the same. You take out a new second mortgage or second lien against some of the equity that you've built in the home. When applying for a home equity loan, they're going to look at the loan to value of your home in relation to the amount of your existing mortgage, and then look at them combined, which is called a CLTV or combined loan to value. Say that you have a home worth $450,000. Your mortgage is down to a loan amount of $200,000. Let's say that you have a child going to college, so you want to take out an equity loan for $100,000 to pay for that. So in our example, $200,000 for our existing mortgage plus $100,000 for our new equity loan divided by $450,000, which is the home's value, we have a CLTV of 66%. That's the number they're going to factor in to approve our new loan and determine that interest rate. Now, that's different from a home equity line of credit, or a HELOC as it's often referred to. Instead of a home equity loan where the lender lends you a specific amount of money that you immediately start paying back based on principal and interest payments, a home equity line of credit is a revolving credit line against the equity of your home that you can use as needed, and the payments are based on what you've drawn or what you've used. The credit limit with a HELOC will usually depend on how much equity you have as well as your credit score. Typically, lenders want you to have a CLTV of 85% or less for this type of financing, but there's some exceptions. I've seen people go to 90, but I haven't seen anybody go to 100 in a very long time. When applying for a HELOC, it's the same calculation as with the home equity loan using the CLTV number. They're going to combine the loan amount of your existing mortgage with the HELOC limit you're applying for, and then they're going to compare that to the value of your home. As a homeowner, it's important to know what type of refinancing options are available to you. So click on this video here to learn more about accessing the equity in your home. In it, I compare the home equity line of credit to a home equity loan and explain what likely might be best for you. I'm going to continue to release videos with mortgage advice each week, so be sure to subscribe to my channel and turn on notifications to catch the next one. Click this link to watch the video, and I will see you there. I'm looking forward to it.